The futures contract is like a large station wagon carrying a group of bonds. The bonds that are most important sit in the front and have the most impact on its direction and speed. But during some instances, the forgotten bond in the back can grab control of the steering wheel.
Honestly, don't think you're going to find the Grand Canyon on this road.
Dad, I haven't seen a car for an hour.
Oh, shut up, Audrey. You don't think Dad knows where he's going?
Thank you, Russ.
You're lost.
Tuesday, September 19th, 2023, Monaco 64, home of alternative economics and contrarian views. So the Bank for International Settlements, or the BIS, is warning again of a major repo crisis. And it's all got to do with leverage, derivatives, and the government debt market, in this case, the Treasury market. And that's what we're going to look at today. I'm going to try to explain to you as easily as possible because this is only complicated because they use very different arcane terms to try to keep the public unaware of all this. But suffice it to say, it almost brought the whole system down back in 2019. The Fed had to stop its quantitative tightening. It had to start doing not QE again. And then we saw what happened in early 2020, where they had to come in and bail everyone out. Yes, they had a cover story for that, but I would say it started out back in August, September time with the repo market. And we're going to look briefly into that. Before I start, just like to give a little bit of information on my background so that it will help you explain why I talk about these things. Some of you, of course, know my background. Some of you don't because you're new to the channel. And if you are new to the channel, please make sure you subscribe. Hit the notification bell. We're trying to get up to 100,000, even though that's not the most important thing. So my background is in finance. I started out at a small private bank in Geneva, Switzerland in the late 80s. And the bulk of the business they did was in the bond market, even though we did deal in stocks, commodities and currencies for our clients. My bosses were bond guys. So it's something that I've always been familiar with. I was sent to London when I was in Geneva for an internship to learn about the bond markets. And then eventually I moved to London in 1992 to work in the government bond market. So I first started out in the cash market. What's the cash market? Well, it's the market where clients buy and sell government bonds. And then you have the futures market where clients hedge with futures on government bonds. These futures, of course, are traded on exchanges. There can be also other derivatives that are not in exchanges. They're called interest rate swaps. They're very similar. But the thing you need to learn and know about these derivatives, these futures, because futures are a derivative, they're highly leveraged. So if you've got, let's say, $1,000, you can bet like on almost $100,000 worth of government bonds. So people abuse it. Speculators abuse it. There are people, of course, investment managers who use it to hedge against their underlying securities. So that's the market I've been in, or I was in, for over 20 years. I went from the cash market and I worked in the government bond futures and options market. And it's a highly leveraged market. So I know what I'm talking about when it comes to government bonds, interest rates, yields, futures, derivatives. So what I'm trying to say here, even for people like me who were in these markets, it's very like you need to do a lot of homework to understand everything. It's some people that worked in the markets, they just executed the trades. They didn't really know what was going on. So don't worry if you don't understand what's going on here. All you need to understand is that this government bond market is mushroomed. And why is that? Well, because of all the debt. Yesterday, the U.S. public debt just reached $33 trillion for the first time. Back when I was in the city working in these markets, I think it was less than 10 trillion. So everything is multiplying. The leverage is multiplying. Up until recently, fund managers, hedge funds, speculators, they weren't getting much of a return, so they have to try to leverage even more. And they're still doing it despite the fact that they could get 5% now for their money, but they need to create more returns or else they lose their clients' funds. What's the point of keeping my money with you if you're not going to give me anything extra? Why should I pay all these fees? So they're still leveraging a lot. So that's where I'm coming from. And I've warned, of course, since I started this channel in late 2015 about the derivatives time bomb, because the derivatives, they have overwhelmed the underlying markets a little bit like in gold and silver. They've done the same for bonds, especially Treasury bonds. And that's one of the markets that I traded the most. Treasuries, also German government bond futures, they're huge as well. So yeah, don't forget to subscribe. So now let's go to the story. And I did videos, of course, back in 2019 all about this, about the repo crisis. And now you've got the BIS, which is, of course, the bank that's supposed to regulate these too big to fail institutions who basically have the hedge funds as their clients. And what are the hedge funds really? Well, the hedge funds are just a creation. They're just like very good traders or traders that were successful at these too big to fail banks, but couldn't keep going there because what they're doing didn't fit in with the banking regulations that the BIS tries to impose internationally. So what do? Well, they leave the Goldman Sachs's of the world, the JP Morgans, whatever other bank, and they create these offshore hedge funds. They're still funded by the prime brokerage arm of all these banks, and these banks provide all the liquidity to them. So it's just like outsourcing all the heavy speculation, and that's why these hedge funds have grown so much, because they're just a byproduct of the banks trying to circumvent the regulations, and that's why I think it's all going to end in tears. And the BIS is warning us about it, and it came out yesterday. Hedge fund bets could spark turmoil in U.S. Treasuries. BIS warns. Short positions in two-year Treasury futures reach record highs in August. And this is not just about the two-year Treasury futures, it's about the whole Treasury market. So let's quickly go through this, and then I'm going to reference this book here, which I've had actually since I started in Geneva, Switzerland. There used to be a bookstore underneath my office and a video store where you used to go and rent cassettes, right, back in those days. And it was an English-speaking one. So it's this book here, Handbook of Fixed Income Securities, by Frank Fabozzi and Dessa Fabozzi. This is supposed to be like the Bible for the bond market, and we're going to reference it in terms of the basis trade. What's the basis trade? Well, wait for me. Let's go through this article. A buildup of leverage bets. There you go, that leverage word. Leverage is just taking on more debt to buy and sell underlying securities. It's a Ponzi scheme, right? And the more the system grows into the trillions and quadrillions, the more leverage these people take. Has the potential to dislocate trading in the 25 trillion U.S. Treasuries market. The umbrella group for central banks said the latest high-profile warning over the potential for crowded hedge fund bets to sow instability. The worst thing about this is that all these too big to fail banks, where some of you might have your deposits with, or some, small businesses, and I'm talking about JP Morgan, Bank of America, Wells Fargo, Goldman Sachs. You see, the other thing they're doing is they're using your deposits to fund all this. And it could all end in tears. And eventually, it was what happened in '08. It was a derivative crisis. And the taxpayer, who knows nothing about what's going on here, had to bail everyone out. And nothing has changed. So it says the Bank for International Settlements issued a warning in its quarterly report released on Monday about the growth of the so-called basis trades, whereby hedge funds seek to exploit tiny differences between the prices of Treasury bonds and their equivalent in the futures market. So how does the basis trade work? Well, let's consult our Bible. And this is on page, I think here is page 1125. It's chapter 52, Treasury Bond Futures Mechanics and Basis Valuation. So what is the basis? Well, a long basis trade involves the purchase of a deliverable cash bond and sale of a factor-weighted amount of futures contract. Going short the basis means selling the deliverable cash bond and buying a factor-weighted number of futures contracts. So basically, these hedge funds exploit the difference between the cash market, the underlying market, and the futures market. And they'll go along the basis, buy a deliverable. What's a deliverable? Well, these futures contracts in treasuries, let's say the 10-year futures contract, right now the one that's traded the most is the December futures. The first delivery date is in I think in the first trading day of December, and there's a basket of deliverable cash bonds that you can use in those futures to deliver when you the person that sells the future, they'll have to deliver in December, so they'll have to have one of those bonds in the delivery basket. It's quite complicated, but that's how it works. So basis trade is nothing more than trying to exploit at delivery. There might be an infinitesimal difference between the cash market and the futures market. It's a difference that wouldn't be worth doing if you bought the whole thing and didn't leverage it. You'd make maybe $2, but if you leverage it 5,000 times, you make $10,000, right? And so that's what they do. It's like the story of Ponzi. The guy who the word Ponzi scheme comes from, he found a discrepancy between stamps in Europe and European stamps being bought and sold in Europe and bought and sold in the US. There's a discrepancy in the price because of the exchange rate, but it wasn't worth doing it because it was so small, the profit. But he kind of created this fiction that he could do it in millions. And this is what this is all about, the basis trade. So let's continue. Whereby hedge funds seek, the current buildup of leveraged short positions in U.S. Treasury futures is a financial vulnerability worth monitoring because of the margin spirals it could potentially trigger, the BIS said in the report, which focuses in particular on leverage used in the futures market to post margin. Margin deleveraging, if disorderly, has the potential to dislocate core fixed income markets. So a lot of people say that the BRICS will need a deep government bond market to have the reserve currency of the world. But here we have this deep treasury market, 25 trillion market. It's very deep, of course, but highly leveraged that could disrupt the whole system. Is it really a good system? I would say not. The Treasury market is one of the world's most closely watched as it sets borrowing costs for U.S. government debt. Yeah, the debt that's just going over 33 trillion. Deficit is doubled from a trillion in 2022 to 2 trillion now in this current fiscal year. It's supposed to drop to maybe 1.5 trillion in the next fiscal year. But if we get a recession, and we're not even in recession right now, when you have huge deficits, where could that go? Yeah, 750 billion in treasury, cash treasuries change hand every day. The unwinding of leveraged treasury positions in moments of stress, such as in September 2019, as well as March 2020, during the coronavirus pandemic, led to wild swings in the treasury and repo markets that ultimately forced the Fed to step in. So nothing's been fixed, of course. These people, they keep making the same mistakes. So what's the repo market? Well, it's the market where, let's say, I'm a dealer in U.S. Treasuries. I have $10 million worth of 10-year notes. But I need to borrow some money because I want to buy, I don't know, something else. So what I will do, I'll go into the repo market and I'll sell those treasuries for a day to a pension fund that has $10 million, and they need to put that to work. So I sell it to them for just under 10 million, and then I buy it the next day. It's an overnight repo. Then I buy it the next day for a little higher prices, and that's the repo rate. So it's collateralized lending. And why would a treasury dealer like me go into the repo market instead of just borrowing the money? Well, because usually the repo rate is lower than the rate that which the bank and the dealer could borrow in other markets. And it's collateralized because it's backed by the treasuries, right? So it's not supposed to be risky. But in 2019, September, that repo rate went through the roof, went to 10%. Basically because there were troubles in this basis trade, in the futures market, and people didn't trust the financial institutions, the dealers. They didn't think they could get hold of these treasuries because there's something called the cheapest to deliver. So I'm going to go through the introduction of chapter 52 so you can have an idea of how messy this thing is, right? So bear with me, and then we're going to look at the markets. But this is very important, and it just goes to show that our whole financial system is at the mercy of these speculators, of leverage, and it could all end in tears. But it would be an excuse for the Fed to step in again and make everything great, right? With even more QE. But let's look at this. This is a chapter that talks about Treasury bond futures mechanics and basis valuation. Since its inception in 1977, the bond futures contract has been the grandfather of the family of financial futures contracts. This has changed, of course, because we now have also over-the-counter derivatives. But let's keep going anyway. It is the primary vehicle for hedging an investor's treasury cash positions and is easily the most liquid treasury futures contract. It has become so successful, in fact, that it is often the driving force of the treasury market. So it's like the tail wagging the dog, right, Rudy? Rudy's asleep. An investor owning a long a bond futures contract can expect the delivery of one group of bonds. So these are deliverables, right? Within a certain time. Conversely, an investor who is short that contract is expected to make the delivery. So that's where the problem comes in. You've got all these basis trades, you've got all these leverage repos and it comes to the crunch and someone can't deliver and it disrupts everything. Conversely, however, the belief that the bond futures contract is simply a substitute for the current cash long bond is potentially a very costly one. So there you go. So a 10-year future is not necessarily the exact same as the 10-year cash treasury note. That's what it's trying to say here. And it can be a costly one. And I think that's what the BIS is talking about. And it's even more costly now. This book was written in the late 80s. So now it's like huge because of the leverage that's grown in the system. The bond future may have the trading characteristics of many different bonds. Depending on the current yield environment, shape of the yield curve, and other factors, some bonds will obviously have a much greater impact on the pricing and consequent movement of the futures contract. One should never assume that only one bond controls its price. And here's the analogy that hopefully will help you understand how fragile these markets are. The futures contract is like a large station wagon carrying a group of bonds. The bonds that are most important sit in the front and have the most impact on its direction and speed. But during some instances, the forgotten bond in the back can grab control of the steering wheel.
I honestly don't think you're gonna find the Grand Canyon on this road.
Dad, I haven't seen a car for an hour.
Oh, shut up, Audrey. You don't think Dad knows where he's going?
Thank you, Russ.
You're lost.
The true essence of basis pricing is determine how likely certain bonds are to gain control and how long they will drive. Frequently, the car that seemed to be driving straight on the expected route can lurch right through a trader's P&L and sometimes right over the trader. This is the paramount importance to comprehend fully the different dimensions of the contract and its deliverability options. So there you go. I don't expect you to understand any of that. What I'm trying to say is that this market is like not what it seems. It's a cocktail of uncertainty. It's a cocktail of leverage and risk. And I think it's not just since 2020, but even before that, the US Treasury, the regulators, the Fed, they've been trying to understand why there's so much volatility and sometimes there's very little liquidity in the Treasury market, which is supposed to be the deepest, the safest market, right, in the world. $25 trillion, trading almost $1 trillion every day. And what does that mean? Well, it means that if an investor or a dealer is going to deal, they're going to get quotes that are very tight and very liquid with enough size on the bid and ask, but it isn't. And I think all the leverage, all these funds and games with derivatives is making this market even worse. And that's why back in March 2020, and it started in September 2019 with the repo crisis, that's why we saw swings like within days of 1% in Treasury yields. I mean, we went from 0.3 one day to 1.3 the next. It was crazy. And you can't have that in a market that's supposed to be the bedrock of the financial system. And that's why I think this is a really important warning from the BIS. So with that, let's quickly look at where the markets are then this morning. It's 8:45 a.m. London time. So we've got spot gold basically unchanged, trading at 1934. Right near the highs of the day, it's been 35, the high. Low's been 28. Spot silver is trading at 23.31. It's up 8 cents. High's been 34 and the low's been 23.13. So to the stock market. Dow futures up 27, NASDAQ 100 futures up 8, S&P futures up 3. Currencies seem to be very steady. I'm not going to go through the major currencies. They're all like unchanged versus the dollar. The renminbi is down a little bit, so the dollar is up 0.1 versus the yuan, just below 730, but nothing really to write home about. Let's look at the other currencies here. Aussie dollar, that's up 0.1% at 64.45. The dollar is down 0.2 versus the Canadian dollar, 134.60. The Kiwi dollar is up 0.25%, 59.30. What about commodities? Well, WTI crude is up 0.2%, trading at 91.11. Brent is up a third, trading just below 94. Platinum, that's up 0.25%, trading around 939. And high-grade copper is down just over 1% actually, trading at 374. So now let's check the bond market. To start with the 10-year Treasury yield. Well, that's pretty much unchanged, around 432. It looks like, yeah, the bond market is waiting for the FOMC's decision tomorrow on interest rates. There are many who think they will raise rates. There is a possibility that they might not. I guess the press conference and the comments they make are going to be very important. But we are, of course, at a very key juncture here in the 10-year yield. If we break through, let's say, 440, it could create a lot of havoc. And even if it goes down sharply, all the volatility could trigger a lot of problems in these basis markets, derivatives markets. A lot of leverage, of course, in those. So what about the gilt market? Well, the 2-year gilt yield is steady around 507, and the 30 years also steady around 477. So it looks like they've got control of the bond market for now. But as the BIS said, things look a little bit under the surface. Things are not really quite right. So with that, I'm going to wish you all a very good day. Take care. Bye.